Okay, so this workshop's about how to pitch perfectly. Most of the workshop will actually revolve around the preparation of what's required to pitch. That's really the secret to a successful pitch. So I'm Vinson Leow, the head of growth of Partisia. So we're going to go through CRT Labs, which is my fund that invested into Partisia, investor types and tiers, why projects fail to raise, what's needed to pitch, anatomy of a deck, project tiers, things to consider before approaching investors, questions to ask after pitch, and closing notes, and then questions as well from you guys. So just some highlights on CRT Labs. So we've invested in more than 150 projects since 2017. We were one of the pre-ICO investors in a lot of big projects such as Celsius and Chromiopolis, actually, which became Chromia. So one of the lead investors in Partisia. So we invested in Feb last year, and I actually joined to raise for the company. So responsible for most of the 40 million that was raised for Partisia. So we raised 55.5 million in total. I brought in a lot of the lead investors, including Jump, Emergo, which is Cardano's fund, Mindworks Capital, which is a $1 billion plus Web2 VC out of Hong Kong, and KuCoin Labs as well. So we've looked at more than 1,000 decks since 2021. So you can imagine, last year when it was a bull market, we were doing about anywhere from 6 to 15 meetings a day, back to back, 7 days a week, just looking at decks. It was a crazy time. And we do monthly deal flow calls with many of the top tier investors in the space. So just a bit of a highlight, some of our investments there. So this is really important to know in investor types and tiers. So usually you have Web3 funds. So it could be like a partner fund or family office. These are very quick to deploy because it's their own capital. Venture capital takes much longer DD time, which stands for due diligence. Then you have ecosystem funds, so layer 1 DApps. They're good to have on the cap table as a signal for investors. By the way, guys, you don't need to take any photos. All of this will be provided to you at the end, including all the links. But you are welcome to take notes if you would like. Then you have incubators, accelerator, and advisory firms, and then service provider funds. So these are like market makers such as Jump, exchanges, marketing PR agencies, legal, and developer agencies, and they usually come with preferential service terms as well. So they're good to have on the cap table because it reduces your outbound cost. Launch pads, this is really important during a bull market. In a bear market, they don't exist pretty much. But they come with a launchpad listing and marketing to the community. And then there's syndicates and pools. So typically you should avoid at all costs unless there is strategic value. The reality is lower tier projects have primarily syndicates and pools as investors. We will go through the sort of types of investors in more detail later on and how they relate to project tiers. And then there's traditional funds. And then there's a hybrid, which is Web3 and traditional. So a lot of the Web2 investors fit in that sort of bracket. So usually about 80–90% of their portfolio. Tribe Capital is a good example. It's a $1 billion Web2 VC, and they have a dedicated $300 million crypto fund. And then angel investors, which is just individual investors. So this is the most used list in the whole world to identify investor tiers, and it's usually between tier 1 and tier 3. There's a link here that links you to all of the investors. I'm not going to go through it today. I didn't make this list, just to be really clear. This was created by people that are anonymous, but every single VC in the world knows about this list, and they all use it as a reference point, especially for projects. So yeah, next slide. Why projects fail to raise? So most Web3 projects are raised based on one of two focuses. So usually they're technology focus. That's really common for projects from China, India, Russia, and Eastern Europe. And then you get marketing focus, which is very common in the Western world, particularly USA. So you ultimately want to be a product, not technology focused. So not the underlying technology, but the actual products and features your technology will enable and what the end consumer will use. And rather than a marketing focus, it should be a go-to-market focus. So that's important to demonstrate a clear understanding of your ideal buyer, all the different buyer segments globally, how your competitors are targeting them and their acquisition costs, and how you will be targeting them more efficiently. So this is how you ultimately demonstrate what's a product known as a product-to-market fit. Very, very few decks actually fit into this unless they're very high caliber. They almost always fall short. This is the case for Web2, Web3. It doesn't make a single difference. More the case because you guys are developers. You're usually very, very technology focused, that you even drop the ball on being product focused, which is what are the specific products and features delineated from the technology. So really interesting fun fact. The single most important factor that impacts your project success is your ability to identify and attract a lead investor, believe it or not. Most investors, if they look at you and your project and your timeline and how much development you've done and what protocol you're bidding on, the idea, they don't care about any of that. If you have a big tier 1 investor on your cap table, that sells them. That's it. That's really, like, to be really frank about it, that's actually the secret. So you should be putting all your focus on finding that lead investor. So focus on investor quality, not quantity. Your starting focus should be to look for a lead investor. And if you do get that good investor, say you have a very, very large raise, 20, 30 million, the whole round will be closed out, right? That's the power of actually having a good lead investor. Good lead investors will allocate most of the remaining allocations to their partner funds. So that's very important. And strong lead investors also validate your project and, like we said, make it very easy to raise more funds. So what's needed to pitch? Before you pitch any investor, you should have your main deck. You should have your 1-pager or 4-pager or light paper. Either of those are acceptable. Then your white paper, obviously. Also your data room. So this is actually something that a lot of earlier projects kind of fall short on. That's kind of like your financial forecast, your go-to-market strategy by region, including like acquisition costs, conversion rates, attrition rates, etc. And then your social media as well. And you could put that on the form of a link tree. So we're going to go through an anatomy of a deck. This is the single most important aspect of actually fundraising. It's important because if you have a good deck, the deck sells itself. You should not be required to be able to sell your own project. And I'll show you exactly why. So just going through top to bottom, it's an overview, the problem, the solution, products and features, opportunity/market sector overview, competitor analysis, go-to-market strategy, token utility, technology stack, team, advisors, roadmap, tokenomics, and raise details. So this is the standard structure of a deck. Most decks don't include some very important things such as go-to-market strategy. So we'll cover that. So overview, this is just the opening slide. So project overview, usually with a vision and mission. If you want to attract the big US players, it's very important that you have a vision and mission. And a bit of an industry overview is something people like to add, not necessarily a requirement in the first slide. Then there's the problem. So, what is the problem? It's really simple. Costs of X are high / time consuming, and there's no capabilities or lack of tools to achieve a result due to XX. That's the standard picture of what you guys are doing. You can apply it to anything. So yep, it's the problem. And then next is, if you want to do a little bit more information about the problem there, breaking down kind of the industry, the continued, with very specific statistics, please always reference. A lot of people don't do that. And like the US VCs especially know that you're just bullshitting them and making up stuff. Believe me, that happens a lot. Any other important data, just whack it into the data room, right? That's important. Because you got to understand with this, especially the US VCs, because they delineated from Web 2, they have like financial analysis analysts that actually go through everything afterwards, right? So if you're not being 100% upfront about the information, they will know, right? So the solution is the next slide. It's always standard. This is where you introduce who you are and what your product is. Basic overview. Just remember, a lot of people make this mistake when they're pitching as a product, but you have your company, which provides a product, and then there's features based on those products. So you need to separate what are you may have more than one product, but each feature is delineated to one specific product. So that's an important thing here. So this is an example of some of the slides that we're seeing. So we're using just, most of the example slides are coming from a company called BitsCrunch. They raised very successfully last year, and then CapEx as well. This is the products and features. So this is showing you CapEx and what they do. So this is usually about 3 to 6 slides. And yeah, we only invested in one of these 2 companies, so you can probably figure out which one by the end of it. This is BitsCrunch's there. So for example, they got Liquify, Scour, Crunch to Vinson. That's 3 of their products or features. And their USP. Having a USP is really important. A lot of people don't really include that in.
Having a what?
Unique selling proposition. Okay. USP, yeah. The next slide is the opportunity or market sector overview. This is usually where they have some generic slide about what's the size of the market and how you're going to capture X. And the market size might be, XXY by, 5 years from now. It's pretty standard stuff. So competitor comparisons, the next slide, include a competitor comparison table. That's really important. But also what's really important is to include a XY axis and a Venn diagram. So that's an example there. It's really important because it really allows investors to see from a really simple way what the differences are between you and others. But the reason why it's relevant is it really allows you to compare yourself to other investors, to other projects. And that's why the XY diagram in particular and the Venn diagram comes in. People do use Venn diagram that also add in logos of the different brands and where they sort of sit relative to themselves. And of course, the 3 circles connecting together in the middle would be your project. Next is the go-to-market strategy. So this is really important. There's usually a business-to-business strategy and a business-to-consumer customer segments. How each segment will be engaged and monetized. And this is actually the most important part of the deck. And this is something that the majority of projects, I would say 80% of decks do not include this information. And this is the single most important deck because it shows that you have an understanding of who are your buyer segments and how you're going to be attracting them. And so if you don't have that, you've simply got an idea with a potential market, but you haven't actually validated the concept even yourself. Next is the token utility. It's pretty standard. Purpose of using the token, really standard. There's usually a burn or a buyback function involved. This is a section that's often ignored. Usually people have a really good tokenomics advisor that comes in to actually help with this. Usually someone that's like a CFA, chartered or a chartered accountant. It's definitely worth having someone doing that for you because a lot of investors really want to focus on token utility because the only difference between your idea and another idea is usually the token utility in a lot of circumstances. So don't ignore this. This is really important. Usually you get an advisor, they usually take 0.25% of the supply and they'll help you out. Next is the technology stack. So it's a breakdown of the technology flow. Shows dApps that engage with your product and how it fits in the Web3 ecosystem. This is also a slide that gets ignored a lot by lower tier decks. So this is giving you an example from another protocol called Astra protocol. It's a KYC compliant project, but this is just showing you what they've done there. So this is pretty cool. Team. So there's some really important notes here. Only add in your leadership team. You do not need to put your whole team. It's not relevant. It's fine if there's lots of talent and you want to show diversity, but always list their credentials. You can see on the bottom left here, CapEx, he's probably got his whole family in there. Like this is a very common problem. If it doesn't show there specifically what they're doing, so if you look here over here on the right, you can see who they are and how they're contributing, some of their previous Web2 experience based on logos, that's fine. Like these are really good, but this they're trying to compensate for something. This happens a lot. If you've got 5 people on the team, it's fine if you just have the 2 co-founders. This is what they did. They raised plenty that way. You don't have to have all the team. People aren't looking for a big team. They're just looking for validation of the concept.
Advisory board.
Yeah, that's the next slide, advisors. So typically there's 4 types of advisors. You can read about here, but they fall under domain expert, or from bottom to top, but domain experts, door openers, golden tippers, and mentors. On the top right gives you the standard percentage that they usually take. It can vary a lot. I've seen advisors getting as high as 1 to 2%. Again, it depends on the role that they play. And bottom right here gives you an example of Astra and their advisory board. They have a pretty awesome advisory board actually. So usually people like to bring on advisors that typically fall under door openers. That's the most common, or domain experts. Just because having them as advisor means you get a partnership with company XYZ, and that's where the value comes in. But if you do find someone that's really good that comes in as a mentor, you do want to keep them, and these are people that you'll be doing weekly or fortnightly calls with. And advisors are a big extension of the team, and they're designed to cover any of the gaps. The most important gap they cover is actually for the go-to-market strategy. So, for example, partnerships and things like that. Logan?
How would you do investing schedules with these, or would you do like an options pool?
Typically, the vesting schedule for an advisor is slightly better than the vesting schedule for a team. So the most common thing you see for a team is usually 12 months cliff and about 2.5 to 4 years vesting. And for an advisor, it's usually slightly better. So maybe something like a 6 to 9 month cliff plus vesting at the same time period. But yeah, that's a good point you raised. A lot of projects make a really ethical problem and they have the vesting too early. You cannot start vesting for the team and the advisors until significantly after the private sale. So for example, if you're starting the vesting at 6 month cliff for everyone, a lot of investors are never going to look at you because they understand that it's an ethical dilemma because you shouldn't be receiving the rewards until your investors have been paid back to some portion, right? So that's why typically team vesting is at least 12 months. Tokenomics slide. This is pretty standard. So usually people stick with 1 billion token supply. It doesn't really matter, but that's just the standard everyone uses. A lot of people ask about like what price you should launch at. Just typically people like to do somewhere from 1 to 10 cents. I don't recommend doing anything less than that because it gets confusing if your token is like, 1 cent to the power of 10. Like it's just like, what the hell? Like when it's on an exchange or it's in the wallet, you just can't figure out its value. And so that's why it's becoming a standard now. These are the standards you see. So the total raise, usually about 15 to 25%. Team is usually 15%. I have seen people try to do less than that. I do not recommend that. Because if the team takes two small portions, say for example, you've got 3 co-founders, they're going to take 10% across the 3 of them. Let's just say then you give the other 5% to the rest of the staff. If say you only do 10%, now you're splitting that 10% instead of being like say 6% between 3 people. It's a problem in the long term because if the founders don't have a lot of tokens themselves, they're less incentivized to make sure the token performs. And so yeah, that's important to say not to make. Then you've got advisors, so usually it's about 2.5 to 5%. And the rest are just general things. Again, ecosystem, 20% marketing, 3 to 10%. Sometimes marketing is absorbed into ecosystem, so it's not really a big deal whether or not you have marketing. And then usually reserve, so whatever's the remainder, usually 20 to 25%. This is the easiest thing to stick to. I see people come up with all kinds of crazy stuff here, like their job stock guarantees. You can see they spend a lot of time trying to work on this for no reason at all. You don't need to do this. You don't need to do it at all. Look what they've done up there, that's a really standard structure. Sometimes there are protocols that have a very specific element of staking, that's a big part of how the protocol functions, so that's why they've got a specific area there. So same with Partisia as well actually. So raise details. We call it vesting schedule or fundraise details. So there's 3 ways raises are usually done. You've got a token only raise where a SAF is issued, so that stands for simple agreement for future tokens. And the valuation is based off the FDV, which is the fully diluted valuation, which means the full amount the tokens are worth once they're all 100% unlocked. Next is an equity raise, so that usually happens as a SAFE, which stands for simple agreement for future equity, and the valuation is based off the equity valuation. And then we have a token and equity SAF, equity raise. This is the most common that you're going to see today. So most people fit in this. So it's a SAFE and token warrant, so it's a 1-to-1 ratio. So if you're raising $10 million FDV, the equity valuation is also over $10 million. I would say at least 90% of the high quality deal flow I've seen this year has been strictly SAFE plus token warrant. If you try anything other than that, it's really difficult. The reason why is when you look at like Web2 investors, especially people like family offices, they want equity, they don't really want tokens. Especially what's happening with FTX and 3AC, they kind of screwed the market for everyone, unfortunately. Tokens alone are just not very sexy in this market, and it's not really a hedge for a long-term bet, and that's the reason why a lot of Web2 investors really require equity. It's not that much more difficult to set up an equity company.
1-to-1 or 1-to-2 ratio?
Usually it's 1-to-1. That's the most common. Yeah, that's the most common. So just over here, this is your typical raise valuations for a SAFT. So usually people raise the seed about 10 mil, private's usually 12 to 20, and private 2 is 15 and 30. If you're raising at a higher valuation because you have a fully working product and you've got revenue coming in and other factors, that's fine. But this is typically what you see It's very, very, very rare to see any project raising more than 30 mil FDV these days, unless it's a big play, like you're a layer 0 or a layer 1 or something crazy. You know, or you've already got like some major client. These things get very confusing. I mean, you can see on the top right, that's probably the best I've actually seen on how to explain how it works. But I would say 50% of these decks don't even show you the FDV of each round, which is really a problem because you know that they have no idea what they're doing. This is a bit of an internal thing we use. So when we do our deal flow with investors, there's a bit of a tier system that we use to speak with investors about. This is how we grade projects. So it's from tier 1 to tier 4. There is no right or wrong. This is just a general sort of structure that we use. So, you know, starting from the bottom, tier 4 projects, which is not where any of you want to be, because your chance of success is basically 0. These are the lowest ones, and that's where we're getting a lot of tier 3 projects involved. Tier 3 is a project tier. Usually 1 to 3 million, and then you've got tier 2 and tier 1. You want to be able to get your quality of what your project is to at least tier 3, ideally a tier 2. Raising more is actually better. People actually like it when you raise more. If you're raising very little, it shows that you don't have a good understanding of long-term market conditions. Because say you raise $1.5 to $2 million, your investors are like, great, so what happens if we're in a bear market for the next 2 years? How are you going to survive? So it's going to cost you $500,000 deposited this in exchange, for example. Do you know that? Well, most people don't. So that's probably a fun fact you guys should know. So most exchanges, there is a listing fee often, anywhere from free to $500,000, but there is also a security deposit that's usually required anywhere from 30 days to 1 to 2 years, and that's $500,000. Plus there's also a marketing that you have to surrender, but that comes in tokens, so usually that's like 250K. So if you're raising 1.5 million, to be honest, it's really difficult to take you guys seriously because you're not going to be able to afford an exchange listing. No worries. Things to consider before approaching investors. So as we covered earlier, investor type, investor tier. So whether they're tier 1 or tier 2, tier 3. Due diligence time, it's usually from 1 to 90 days. I would say the average is about 2 to 3 weeks to attract an investor and close them. The market macro conditions are really important. So if you were raising 3 months ago, it's much harder than raising post FTX. And raising 3 months ago is probably much easier than post 3AC. So 3AC, Celsius at that time. What's their average investment ticket size over the past 12 months? That's important to check with them, what their range is. So that's how much they're willing to invest. Usually they'll give you a range size. Usually it's going to be, if you're a smaller investor, it's 50 to 250. For a lot of the bigger guys, it's usually 250 to 1 million. It's important to know how much impact an investor will have on your project's raise and potential success. And what value you can bring to the investor's portfolio projects. This is an easy way to pitch them. If you know what their portfolio projects are, and say you're offering some sort of B2B product, you should pitch from the perspective of, hey, you've got XYZ and you can use our services for whatever reason. And that's usually a good way to try and get an introduction through them. Focus on high-tier investors first, so they'll actually give you some constructive feedback and a better understanding of how to improve your pitch. So if you can't reach any tier 1 or tier 2 investors directly, you should definitely find an advisor that can help you. So that's going back to the list that I showed you earlier. That's got a list of all the top tier investors in the space. And good investors, this is important to know, good investors only set up a group chat and call with you if they like your project. A lot of people always go, oh, hey, let's just set up a group and everything. If you meet an investor, don't do that. Just be like, hey, this is what my project is. And if they like you, they'll set up a group and with their team, right, go to the next step. If you push for that right now, they're going to be really technical. Questions are asked after a pitch with them, so it's really important to do this. You'll be surprised how many projects go. But just ask them, what are your thoughts on the project? Was there anything you didn't like or would like to see? What's the next steps from your end? So it's important to understand what's called the SOIs, the sphere of influence. These are the key decision makers for closing the deal. So usually they'll say, I'm the general partner, it's getting referred to the senior partner who's the founder, and the three of us make a decision with somebody else. Usually they'll tell you that. So, and how long does it normally take you to make a decision? That's really important to know. Okay, this is actually how VCs share most of our deal flow. So this is why I'm saying if the deck can't sell itself, you need to really fix the deck until it can. You need a clear and concise 1 to 2 line elevator pitch. That's really it. And all the developers, they'll tell you 100 lines about why their project's amazing. People don't want to hear it. You need to be able to sell them in 30 to 60 seconds. That's it. These are examples of what happens within VCs. So we share deal flow based on this format. It's just usually the website of the project, one line about the project. Sometimes if they break down the products and the features clearly, like for example with PayScript, on the right there, we break down some of the features, and it's like a pitch deck, the white paper. And usually the investors that are confirmed. Right, this is how we talk. This is what I was saying, like the investors are so important. Like even when I invest, the first thing I look at are who are the lead investors. Because if they don't have good lead investors, then that demonstrates that they don't have an ability to figure out what's going on in the market. Right. And then usually FTV is really important, fully diluted valuation. You can see that's mentioned a couple of times here on the bottom. Cool, just some closing notes. Focus on a strong lead investor or set of lead investors. Identify your project tier and target investors that are interested in your project tier. So there's nothing wrong if you're a lower tier project. You just need to realize that you're not going to be able to attract a higher tier investor, that's all. Don't be afraid to pivot the concept or pitch to what appeals to investors. That's when you know you've hit a good product to market fit. A lot of the really good decks, like we've seen them come out to us and we said no, and then 3 months later it's a whole different product. That's fine. You're in a very early stage. It's the best for you to pivot as many times as you can now until the investor is interested. Right, this is also a side thing. Projects normally do like a referral agreement. They get a lot of people that help them fundraise. So industry standards 5% and can range from 4 to 10% commission to incentivize individuals to help them raise. So this happens a lot with companies as a service and say, oh, we're going to work with you and raise for you. It's all commission based. If they try to take anything up front, they're trying to scam you, just say no. It's really simple. You'd be surprised how often that happens. Fundraising can take up to 12 months, especially in these bear market conditions. So it's important you guys know to just be very patient. It's not going to be easy. If you come into the project and raise $3 million in the next month, I'll be really, really impressed, put it that way. And I'll also invest. but yeah, if you can launch a product without a token, this is preferential for investors because we are in for a bear market. Realistically, it's going to be 2 years, right? Because of the US and Europe and global recession we're experiencing next year, right? That's just the reality of, because crypto is, directly correlated with traditional equity markets. So yeah, if you can launch the product and actually getting volume in use case and then launching the token later, it's much, much easier because now you can come back and say that we've got 10,000 customers and we've got $500,000 of revenue, whatever it's going to be, as opposed to where you are now compared to 6 months from now. Cool. The deck links are available here as well, so you guys can access this there on the links. That's it. Yeah.